Remember the term non-dom? It was all over the news back in 2022 when Rishi Sunak's wife, Akshata Murthy, was revealed to have non-dom status. This meant she didn't have to pay UK tax on her overseas income. This whole situation threw a massive spotlight on how the UK taxes the super rich and their assets abroad. Since then, the rules have been completely shaken up, especially when it comes to inheritance tax. It's not so much about this fuzzy concept of domicile anymore. Now it's all about how long you've been a tax resident in the UK. So, if you have assets overseas or you're thinking of moving abroad, you need to understand these new rules. Today, we're going to break it all down for you. First, let's do a quick refresher on inheritance tax, or IHT. When you pass away, IHT is a tax on your estate, which is just a fancy word for everything you own. Your house, your savings, your investments, everything. The good news is, you can usually leave your entire estate to your spouse or civil partner completely tax-free, as long as you're both long-term UK residents. For anything you leave to other people, like your kids, the first £325,000 is tax-free. This is known as the nil rate band. Anything above that amount is typically taxed at a hefty 40%. There's a little extra help if you're passing on your main home. Now for the big question. Do you have to pay UK inheritance tax on assets you own outside the UK? Your holiday home in Spain, your apartment in New York, your shares in a foreign company, are they in the taxman's sights? The answer is sometimes yes. Under the new rules, it mainly boils down to a residence test. The key question is, have you been a tax resident in the UK for at least 10 of the past 20 tax years? The 20-year period is counted backwards from the tax year before your death. If the answer is yes, then congratulations. You're considered a long-term resident. And as a long-term resident, your entire worldwide estate, including all those overseas assets, becomes subject to UK inheritance tax. There is a slightly different rule for younger individuals. If you're under 20 years old, the test is whether you've been a UK tax resident for at least half of the tax years since you were born. So the old days of relying on non-dom status to shield foreign assets from IHT are gone. The focus has firmly shifted to your long-term connection to the UK, measured by your tax residency history. This makes understanding your residency status more critical than ever before. Okay, so we've established that being a long-term resident is the key. But that just leads to the next obvious question. How do you know if you are a UK tax resident in any given year? If you thought the previous rule seemed a bit too simple for the world of tax, you were right. This is where things get a bit more complicated. The process for figuring out your tax residency is detailed, and it's not always straightforward. What I'm about to explain is a general guide, but because these rules are so complex, it's always a smart move to talk to a tax professional before making any major financial decisions. As one expert from the accountancy firm RSM put it, the rules might look simple on the surface, but there's a lot of complexity hiding underneath. The tax authorities, HMRC, use something called the Statutory Residence Test. This test has a few stages. The first stage is to see if you can be automatically considered an overseas resident for tax purposes. There are 3 automatic overseas tests. The first one is if you were a UK resident in at least one of the last 3 tax years, but you spent fewer than 16 days in the UK during the current tax year. So, a very short visit. The second test applies if you weren't a UK resident in any of the last 3 years, and you spent fewer than 46 days here in the current year. And the third test is if you work full-time overseas, with only very limited visits back to the UK. This test has its own detailed calculations about what counts as full-time and limited visits. If you meet any one of these 3 tests, then you're automatically not a UK tax resident for that year. Simple as that. If you don't meet any of those automatic overseas tests, the next step is to see if you automatically qualify as a UK resident. Again, there are 3 automatic UK tests. The first one is the simplest. Did you spend 183 days or more in the UK during the tax year? If you did, you are automatically a UK tax resident. No ifs, no buts. The second test is a bit more nuanced. It applies if you have a home in the UK that as available to you for at least 91 consecutive days, and you actually use it for at least 30 days in the tax year. A crucial part of this test is that you must also have spent fewer than 30 days in any overseas home. The third automatic UK test is based on work. If you work full-time in the UK for any 365-day period that falls partly within the tax year, you'll be considered a UK resident. So, if the automatic tests don't give you a clear yes or no answer about your residency, we have to move on to the next stage of the puzzle. This is where we get into the sufficient ties test. This part of the test looks at the connections you have to the UK. There are 5 different ties that can link you to the country and potentially make you a tax resident. The first is the family tie. This applies if your spouse, civil partner, or a child under 18 is a resident in the UK. The second is the accommodation tie. This applies if you have accommodation in the UK that is available to you for at least 91 consecutive days in the year, and you spend at least one night there. Note, this is just one night, not the 30 nights from the automatic test. The third is the work tie. This applies if you work in the UK for more than 3 hours a day for at least 40 days during the tax year. The fourth is the 90-day tie. This one looks backwards. It applies if you spent more than 90 days in the UK in either of the previous 2 tax years. And finally, the fifth is the country tie. This applies if the UK is the country where you spent the most number of days during the tax year, provided you were a UK resident in at least one of the last 3 years. Now, here's where it gets even more confusing. Having one or more of these ties doesn't automatically make you a UK resident. The number of ties you need to be considered a resident depends on 2 things: how many days you spent in the UK during the current tax year, and whether you were a resident here in the previous 3 years. It's a sliding scale. For example, if you were a UK resident previously, you might only need 2 ties to become a resident again if you spend a certain number of days here. But if you're arriving in the UK for the first time, you might need more ties for the same number of days. It's a complex matrix of days and ties, which is why getting professional advice is so important. So let's say you've done the tests and you're indeed a long-term resident. Your worldwide assets are now exposed to UK inheritance tax. Is there any way out? Can you escape this liability if you leave the UK? The answer is yes, but it takes time. You don't just lose your IHT liability on overseas assets the day you move abroad. You, Ella, remain liable for IHT until you have been a non-UK tax resident for a specific number of consecutive years. The exact length of time depends on how long you were a resident in the first place. If you were a UK tax resident for 2 decades or more, you're in for the long haul. You will need to be a non-UK tax resident for a full 10 consecutive tax years before you're overseas. Assets are finally free from the UK's inheritance tax net. However, this period can be shorter for those who are UK residents for less time. The rule is that it tapers down. For someone who was a UK tax resident for between 10 and 13 years, the required period of non-residence is 3 years. For every additional year you were a resident beyond 13 years, you have to add an extra year to that waiting period. Let's use an example to make that clearer. Imagine you had been a tax resident in the UK for 15 years. You then decide to move abroad and become a non-resident. To lose your UK inheritance tax liability on your overseas assets, you would need to remain a non-UK tax resident for 5 consecutive years. That's calculated as the standard 3 years, plus an extra 2 years for being a resident for 15 years instead of 13. This tapering system means the longer your connection to the UK, the longer it takes to break that tax link for IHT purposes. While these rules might seem more complicated than ever, there is a silver lining. According to Joseph Adance from the accountancy firm Moore Kingston Smith, one of the quirks of these changes is that they actually provide more certainty for Brits who have left the UK. Under the old domicile system, there was often huge uncertainty. Someone could have left the UK many years ago, but if HMRC decided they still had a UK domicile of origin, their worldwide estate could still be caught by inheritance tax. It was a gray area that could lead to nasty surprises. The new rules, based on a clear count of residency years, make the situation much more black and white. Now, if you leave the UK, you have a clear timeline. You know exactly how many years you need to be non-resident before your overseas assets are safely outside the clutches of the UK taxman. So, to wrap it all up, the landscape for inheritance tax on overseas assets has fundamentally changed. The vague concept of domicile has been replaced by a much clearer but still complex system based on tax residency. If you've been a UK resident for 10 of the last 20 years, your worldwide assets are likely on the hook for IHT. Escaping that liability means leaving the UK and remaining a non-resident for a period of between 3 and 10 years. Navigating the Statutory Residence Test and its web of automatic tests and sufficient ties is crucial. Given the stakes, with a 40% tax rate, understanding your position is vital for effective estate planning. Thanks for watching. We hope this breakdown has helped demystify these new inheritance tax rules. If you found this video useful, please give it a thumbs up and consider subscribing to our channel for more financial guides. See you next time.